consolidated cash flow. So please, we are expected to know accounting for associates, how to consolidate cash flow. When we talk about associates, it's just one line item in the income statement and one line item in the statement of financial position. In the income statement, we have the profit from associates and affiliates. In the statement of financial position, just one line, investment in associates. So the problem should not be accounting for associates. And when it comes to the complex group, what is making it complex is just the indirect holding adjustments. The NCI rate on the amount paid by the main subsidiary to acquire the sub-subsidiary. That is making it complex, the indirect holding adjustments. Apart from the indirect holding adjustments, the basic consolidation is not different from the normal consolidation. And with the consolidated cash flow, which we're going to solve a question today, in fact, we have been expecting consolidated cash flow, and I see it's yet to examine your consolidated cash flow. So what it means is that so far as this exam is concerned, consolidated cash flow is a probable area. To be honest with you, it's part of the probable area so far as your exam is concerned. When you are preparing yourself for the exam, prepare yourself on the cash flow statement. It's possible that you'll be given a question on cash flow. Cash flows are not that difficult. So if you are given a question on cash flow, it means that passing this paper should be very, very easy for you. Foreign subsidiary is just like the main subsidiary, just that we do translation. All income statement items will be translated as average rate. Statement of financial positions item will be translated as closing rate. The income statement average rate. Balance sheet item closing rate. So just translate it and add the figures together. That is making a foreign subsidiary. So please, let's prepare ourselves on consolidation because it is coming in the exam room for 25 months. So when you are revising, make sure that with the consolidation, especially with the copy back, you get all the 3 marks. You leave it, you go and solve other questions. You come back to the consolidation and complete it. You need to strategize very well in the exam room if you want to pass this. It's about strategy. Sometimes, if you look at the nature of the question and the time given, if you are giving more hours, you'll be able to pass. The problem is your ability to manage time. And for corporate reporting and even financial reporting are the two. The time given will not be enough for you. At least, let's strategize and make good use of our time. Then the next one, which is a very simple area, is interpretations to company's financial statements using accounting ratios. Interpretation will be in the exam room for 20 marks. How to write reports. So with the interpretation, we can be giving a question on interpretation. And when it comes to interpretation, the key thing is the writing of the report, the formatting of the report. How you need to format your report from date, subject, introduction, then the content will come, conclusion. Then you sign a report. The formatting of the report is very, very important. How you format your report. Sometimes the examiner will use the financial statement with another estimate. He calculates the key financial ratios and comment on it. Just calculate the key financial ratios and comment on it. We can easily get 18 out of 20 here. And if you are getting 18 and more than half of the consolidation, you pass the report. The consolidation will be the exam for 20 marks. The next one is specialized transactions. We are meeting specialized transactions for 15 marks. And the specialized transaction has to do with only two topics: capital reduction and business valuation. So the question can be on business valuation, the question can also be on capital reduction. So the business valuation is about the determination of value of businesses. And for capital reduction, the first part is the preparation of the account, and the second part is the scheme design. And when it comes to the scheme design, the order to pay the stakeholders is very, very important. So what order are you supposed to follow? So don't forget that you pay the debt that is secure with the first charge. You pay the liquidation cost, you pay preferential and other statutory payments. Then you come to debt secure with the floating charge. After paying the debt secure with the floating charge, then you pay the unsecured debt holders, or you determine the amount available to all the unsecured debt holders. After paying the unsecured debt holders, if you still have money, you pay preference share capital and their dividends in arrears. Then you also pay the ordinary shareholders. Okay, so that is for capital reduction. So the question can be on capital reduction or business valuation. Okay. The next one is the theoretical aspect, which is going to be only ethics. Please, for ethics, just check the past question. Realize that the examiner has been setting the same question for 10 marks. For 10 marks, the same question. So please, don't be so motivated about the calculation. The most important thing is to pass. Have you gotten it? So if you are not supposed to struggle too much to get all the 10 marks here, get the 10 marks, support it with the interpretation. You get close to 28. You need only 50 to pass. With a specialized transaction, you can easily get 10 out of the 50 or 12 out of the 50. So when you get your 10 to support, you are doing something. You do not take it. Then you share the interpretation with the consolidation with the examiner in our class before you even face the standards. Shall we get it? The last part is the standards. And the standards is supposed to be in the exam for 30 marks. High school is saying that as a professional, you need to understand the IFRS, and that's the major reason why we examine 30 marks on all the IFRS. And for corporate reporting, standards like share-based payments, standards like financial instruments, standards like employee benefits, be comfortable with it. Share-based employee benefits and financial instruments. These are proper corporate reporting standards. Then you can also be examined on the other general standards, which is not different from the two of the financial reporting standards. So please, this is the syllabus rules. So before you write or you go to the exam room, somewhere next 3 weeks Monday, please be thinking about this. Be doing your personal calculation, how you're going to approach the paper and pass. I've been saying that when it comes to corporate reporting, you can do your own mathematics before you go to the exam. If you are spending all your time learning standards, you go and you may be disappointed. The standard that will be given to you will not be familiar standard questions. It means that you are coming back to write the paper again. So please, learn the standard, get the general knowledge of the standard. Move on to other areas. Make sure learning ethics is not difficult. It's a matter of talking about issues of integrity, talking about issues of objectivity, professional competence and new care, issues of professional behavior and confidentiality. Just read it, write the headings, and in any ethics question that will be given to you in corporate reporting, integrity will be part of the answers. If you have to raise the ethical issues, integrity will be there. Objectivity will be there because all the threats to the auditor's independence is objectivity, or it has to do with issues of objectivity. So integrity will be there, objectivity will be there. Sometimes, depending on the nature of the question, you need to raise issues of confidentiality and professional competence and due care. So please, with this 10 marks, let's strategize. If you're able to strategize very well, you will pass. Okay? It's not about knowing the in and out of the standard or knowing the in and out of the course. It's about strategies to pass. This is how we get there. One thing about corporate reporting is that you can understand all the topics, but you may not pass. If you are able to manage your time very well. So we need strategies to pass. Yes, sir. the corporate reporting paper, make sure you are comfortable with these areas. How you get it? You need to strategize. You sit down and do your own mathematics. It's not about knowing the in and out of the course. It's about strategizing to pass the paper. And if you're able to strategize very well, after 2.5 hours, you should pass. Because with the consolidation, after adding the figures together or doing the copy backs, you know very well that you have not treated a particular note, which will affect the computation of the new note. How you get it? So why do you have to waste your time and add the people figures together? It's a waste of time. This is how you get it. Okay, you know that some of the figures are not correct. So why do you have to waste your time and add all the totals together? Because your total will be wrong. Please use the time very well. So finish with all your copy backs. You go and solve other questions. You do small adjustments. If you still have time to use, then you come back and add the wrong figures together. Are you getting it? But if you don't have time to waste, just leave it and solve other questions. Because the most important thing is to pass the paper. You need to strategize and pass. If you're able to strategize very well, you write the exam and you'll be happy with your results. Because it's very easy to get, when you are preparing yourself for the exam, you know that you don't need to spend more hours learning interpretation. When you are learning interpretation, even the difficult ones, the one with cash flows, you don't need to spend more hours learning interpretation. And the good news is that we have been examining on all the issues around interpretation. The past questions are there. So understand the principles, apply it on 3 or 4 past questions. These are we following. Just apply it on 3 or 4 past questions, and you know that if they give you any question under interpretation, out of the 20, you are getting close to the 18. So let's assume that you are getting 18 here. With this theory ethics, because it's the same question coming every sitting, please try and get 9 or 10 over 10. Ethics. So if you are getting 9, okay, specialized transactions. If it is not business valuation, capital reduction will be coming. Business valuation, be comfortable with 4 methods of valuation. It's popular in the exam. The PE ratio method, the dividend yield method, the cash flow method. Okay, so dividend yield, PE ratio method, net assets method. If you are comfortable with these 4 methods, all the questions and the business valuation, you'll be able to do it. These are we getting it. And with the capital reduction, it's just the individual account, the capital reduction account, which is the nominal account. The debit side is an expense, the credit side becomes income. What is expense in accounting? When assets increase, it's income, it goes to the credit side. When assets decreases, it's now an expense, it comes to the debit side. The opposite is equity and liability. Just apply the principles to prepare your capital reduction account. And with the new statement of financial position, just do the new figures together. And you realize that the capital reduction and business valuation is not a difficult area. So please, with that one, you can target close to 12. Okay, with the consolidation, the 5 months attached to the consolidation are theories of consolidation, control, circumstances under which we will be permitted by the standard to consolidate and the rest. It's not difficult. You can write and you get all the 5 marks or 4 out of the 5. So if you're even getting that 4 marks and sharing the 20 marks, is it not 14? So you add 14. So when you add 1, 2, 3, 4 together, you are close to passing the paper. Are you getting it? So with the standards, before you play the standard, you know that you have passed. This is how you get it. So if you even get 8 of 8 over 30 here, if you fail the standard, you have passed the paper. But you see most students wasting a lot of time on the 20 marks under consolidation and the 30 marks under the standard. If you want to learn all the standards and know it very well, please, it will take a lot of time. To be honest with you, it will take a lot of time. Even though we are expected to know it, but it's going to take a lot of time. So as much as possible and get a fair knowledge of the standard. The question that we have discussed, we solve it. when the person is given to you, then you are not even familiar with the person, but you have fair knowledge and understand that you can write something and the examiner will give marks. Is that what you're saying? Strategize. It's a matter of applying strategies and the results will come in happy. So please let's sit down, look at the syllable sheet and strategize very well. You go and be able to write and pass. Okay. Okay. Is any question for me before we solve maybe 2 questions under consolidation, 1 question under interpretation, 1 question under capital reduction, 1 question under business valuation. We'll discuss a question under ethics and solve some question under standards. Any question for me? Okay. So if you don't have a question, then let's take our papers and go through. We will solve some questions here. Okay, so this cash flow statement question we solved it before, but I'm going to resolve it because this is the only cash flow statement that I've been examining before. And one thing about cash flow statement is that it's highly mechanical. It follows basically the same format. So please, once or because we are expecting cash flow, if you go and a similar one is given to you, it means that you have to score higher marks. It means that your target is no longer reached. But one thing about corporate reporting is that if you go and meet a question that you have solved before and you are not careful, you waste all the time on it. Because if you are wasting close to 2 hours on only consolidation, which is possible in the exam room, if you are wasting 2 hours to get 20 marks, and even that 20 marks, you are not getting everything. The maximum that you can get will be 18 out of the 20. Okay, and you are wasting 2 hours to get 18. Then it means that you need another 2 hours to get additional 18 or 20. So what it means is that you are coming back to write the paper again. So please, let's strategize. Sometimes, not because you cannot solve the question, but because you want to pass. You work up to a particular level and you leave it and go and solve other questions. Literally getting it. You just work up to a particular level, you leave it and solve other questions, and then when you are done and you still have time, you come back and solve it. But my advice is that, please, for corporate reports, you have to write very, very fast. Just that your handwriting is supposed to be readable. Write very, very, very fast. But your handwriting is supposed to be readable. Okay, we are not saying that beautify your handwriting, but it's supposed to be readable. So once your handwriting is readable and you write very fast, the results will come and you'll be very, very happy. Is that we getting it? Okay. So we will look at 1 question under consolidation. Then when we come back from there, we will solve another question under consolidation with a bit of foreign subsidiary item in it. That is the question number 1. Yes. So we're going to solve 1 question under each of the areas. So we are starting with the cash flow statement. So let's start with the cash flow statement. You read the question for us to discuss it together. And we're going to solve it in the exam room. So when the question is given to you, please, and for this particular paper, let me mention this. Try as much as possible and get to the exam room very early. Okay? Get to the exam room very, very early. So that once you get there, the question paper will be given to you. You go through and you see the lot of time there. Because the limitation to the paper is time. So once you are giving the question paper, before they tell you to start with, at least the excess, you have all the points to write. And with the consolidation, you have gone through the notes. And the other areas, you know what to do. So get to the exam room about 15 or 20 minutes before they tell you to start work. So depending on where you are writing the exam, even some places, when you get there 30 minutes before the paper, the question paper will be given to you. So when you get to the exam, you don't need the question paper.
You all have to send it before this day, and then you give you the 15 minutes in the meantime before
Oh, but once you get it there, it depends on where you are writing it. So once you get it there,
if the time is up.
they will share
They will share it.
but they will not give you. When you come and then you locate your seat, they will bring you the person.
But they are not supposed to wait for everybody
come
to
and then
sit
they
before
time is over. They will see you. It's just that everyone is always in before they start. That's why I see that way. Yeah, I've seen people coming late.
Yes, because when you get to the exam late, or if you need a 15 minutes period time, you need that is your own time. You are consuming your own time. Are you getting it? But if you're able to get there before the 15 minutes period time, you have 15 minutes in addition to the 3 hours. But some people will get to the exam very late. Okay, they want to, I don't know what they are reading us at that time, but they want to get some point before they get to the exam room. If you are wasting your own time. So try and get there maybe 20 minutes before time. You relax. If the answer booklet is given to you, even before the question paper, sometimes they will give you the answer booklet before the question paper. So when the answer booklet is given to you, what are you supposed to do? You do all the fillings. Your index number, page numbers, and the rest. These are really getting it. And we have been cautioned. If you read the chief examiner's report and the meeting that we had with the chief examiner, you see students writing in their margin. Sometimes you pass, but the person marking your paper will intentionally fail you because of what you are doing. Are you getting it? As a professional, you have been given instruction to follow, and you don't want to follow it. Don't write in the margin, and you are still writing in the margin. The way you are arranged the question number 2 will be here. But when you go in between, you see question number 3B in question number 2. Please, it's happening so. So if it's question number 2, everything is supposed to be question number 2. Are you getting it? If it is question number 3, everything is supposed to be question number 3. Some people also use this approach, question number 1, 2, 3, 4, 5. If they are not able to do it, they will leave a space for it. So that the person marking your paper will know that it follows that order. Please, are you getting it? We can strategize and manage the examiner. And somebody will dash you marks and pass you. Sometimes you check your results and it means somebody has supported you to push you to go away. Okay. I know one woman who had 51, 52, 53. One sitting on, and she passed all the 4 papers. Yes. She passed all the 4 papers one sitting. The highest was 54. 51, 50, 52, 54. So please strategize. If you strategize very well and you present your answers very well, the person marking your paper will find it difficult to do it. But sometimes when you go through and you look at the handwriting, the way the person has presented it, you want to force and push the person to go. But if you don't arrange it very well, you'll be writing in margins, the order of your answers is not in the booklet. You yourself, you are confused. Nobody will pass you. Are you getting it? So please, this is key. This is key. Let's strategize. And when you strategize, you realize that you not strategize so much. The results will come and you'll be very happy. Okay. So we are starting with question number 1. Somebody should read it for us to solve it together. Question number 1A.
Prepare a consolidated statement of cash flow for the Barcode Group PLC for the year ended 31st July 2016 in accordance with the requirements of IAS 7, Statement of Cash Flow. The following consolidated financial statements relate to the Barcode Group PLC. The following information
the goal of the first page is the operating activity. Then the second page, we divide it into two. Investing activities and the financing activities. How we get it? Because a lot of the items will be under the operating activities. And with the cash flow statements, what you have to know is that with the operating activities, we're thinking about items in the income statements. Inventory, receivables, and payables. That is the movement in working capital. So the items in the income statement, inventory, receivables, and payables, before you face the other issues. Okay. So we have the cash flow statement here. The heading will be in line with the requirement. So you write the name of the company, PLC, statements of cash flow for the year ended 31st of
July 2016.
So we just write cash flow from operating activities or just operating activities. If you have 3 zeros on top, then you write, you have 3 zeros on top of all the figures.
Yes.
Operating activities, cash flow for operating. We have the investing activities. And the last one is the financing activities. Okay. So with the operating activities, let's go to one thing about cash flow statement is that it's highly mechanical. Highly mechanical in the sense that it follows basically the same format. So the preparation of cash flow statement follows the same approach. Okay, so with our operating activities, we will start with the profit before tax. Let's go to the income statement.
Revenue.
Now, go to where you have the profit before tax. And that is the approach that we need to adopt.
Profit before
I have shared the format with you, so you know the format and apply the format in any question that will be given to you. But whilst we are going through it, if you have any questions, please feel free and ask your questions.
Profit before tax. 4,050.
So profit before tax is
4,000.
40.
Interest payer.
Then we go up. So once we get to the profit before tax, we move up. What's the next figure up there?
Interest payer.
So interest payable has been deducted. So what we do is that we will add back. What are we adding back? We are adding back because the interest payable may include elements of OUs. How we get it? This is the indirect method. We are adjusting the profit for the year to remove all the accruals from the profit for the year. So the interest payable may include elements of OUs. So what we're going to do is that it has been deducted. We will add back and later calculate interest paid in the form of cash and subtract the interest paid in the form of cash. We have the interest payable. The amount involved is 300.
Yeah.
Yes.
So it has been deducted, so you add back. The next figure up there is
Income from investment.
income from, that is the finance income. Okay, income from investment, finance income or interest income. So that one should have been added. What are you supposed to do? So finance income or income from investment. It has been deducted. So what we do is that it has been added. We will subtract. The amount is. So please note this. With the finance income, in most cases, the figure will be the same as the interest received in the form of cash. Okay? And whilst preparing the account, you may forget. What you need to do is that anytime you write the finance income here as minus, go here and write interest received. But when you write the interest received, don't write any figure there. So that if there is any adjustment, we do the adjustments and write interest received. Are we getting it? What's next?
Profit on disposal of tangible material.
Okay, so we're going to determine the actual cash received from the sale of non-current assets, which is part of our investing activities. So the profits which have been added will be a duplication. So what we need to do is that we need to subtract. So profit from
disposal.
Profit from sale of assets. The amount is
300.
okay. What's next? It has been added, so we need to subtract.
Next is operating cost.
What?
Operating cost.
Okay, then the next is on top.
Income from interest in associates and acquisitions.
So we're going to determine the actual cash received from investing in associates. So the income from associates that are taken will be a repetition. So we have to subtract. So that is the profit from associates. It has been added, so we're going to subtract. The amount is 990. Okay, what's next?
Expenses.
The next figure on top is,
Administrative
so
expenses.
these are cash expenses.
Distribution cost.
That is also cash expense and the gross profit. Okay. Now come down after the profit for the year, you also descend down. What figure is there?
Non-controlling interest.
Which we will consider later. What's next?
Profit attributable to members. Members of parent company. Dividends paid.
So this is actual dividend paid, which is a financing activity. So we write it here. Dividend paid. So you are not supposed to finish with operating before you move to investing or financing. What was the dividend paid in the form of cash? 800. So you write it here. Let's move on. What's next?
Statement of financial position.
Footnote.
Additional note. The bank holding PLC has two wholly owned subsidiaries. In addition, it acquired a 75% interest in Yanoma Limited.
So please pay attention to this part. In your exam room, it can be acquisition or a disposal. When you are giving questions on a cash flow statement, it can be acquisition of a subsidiary or a disposal of a subsidiary. So you have to watch. If it is acquisition, you're going to add a figure. If it is a disposal, we're going to subtract. Are we getting it?
It also owns a 40% interest in Bankomi Limited, which it acquired several years ago.
Okay.
Goodwill has not become impaired.
So there is no goodwill impairment. If you have goodwill impairment is non-cash item. We're going to determine the goodwill impairment and add it back. Impairment, amortization, depreciation, provision, they are all non-cash. We just add it back.
The following recorded as fair value refers to the numeric at the date of acquisition. Statement of financial position.
Okay.
Plant and machinery.
So that is the assets that the subsidiary will be bringing, the new subsidiary.
The III. The consideration for the purchase of the shares of Yanoma Limited comprised 44,000 ordinary shares of 1C of Bankomi PLC at a value of 550,000 and a balance of 28,000.
So we need the cash. The balance of 28,000 was paid in cash. So what was the cash paid to acquire the subsidiary? 28. Literally saying the cash paid to acquire the subsidiary is 28. And that subsidiary is also coming in with cash of. So let's go to the balance sheet that we just read. What is the cash of that subsidiary? Literally all follow me. We are paying cash of 28, and that subsidiary is also coming in with a cash of 224. So it means that we have an inflow of the difference. And what will be the difference?
That one again.
Okay. So we pay cash of 28, and the subsidiary that we have acquired is also coming in with a cash of 224. Are you getting it? So it means that instead of the cash paid, we are now receiving the money because we are paying cash of 28, and that subsidiary also coming in with a cash of 224. So we have a gain of the difference. Is that getting it? It's like you're going to buy a business, and that business is having money sitting in the bank account. Okay. So investing activities, cash paid to acquire subsidiary. We pay 28, and the subsidiary is coming in with a cash of 224. So what it means is that we have a gain of 196. Okay, that's fine.
The taxation charge in the consolidated statement.
Okay, so before we go, because we have acquisition of a subsidiary, my advice is that if you don't want to waste time in the exam room, use the information to calculate goodwill and write and put it down. The goodwill of the new subsidiary that you have acquired. So workings number 1 is going to be goodwill. So with the goodwill is a consideration over the net assets. So what was the fair value of consideration? We have a share exchange. Share exchange of 550 and cash of there's going to be 570. Then we will less our share, each share of the net assets, which is the same as equity. We have acquired what percentage of Namima? 75. So what was the total equity? Because we've been able to prove that the net assets is the same as equity. 504. So 75% of 504 will be 300. Okay. So 578 minus 378 should be. So there is a goodwill of 200. So that is going to be our workings number 1. So please, whilst we are solving it, if you have a question, you just ask. I know we've solved this question before, but it's very hard.
I just want to know the dividend, the balance that it has, the dividend account.
Okay, so with the dividend, if it is dividend payable, it's different from dividend paid. I get it. If it is dividend paid, that is the cash. This is cash flow. We are interested in cash and cash equivalent. Once you are giving dividend paid, just read it.
Just the normal, just the general one. That if you open the account, how the balance it will know you have.
That is where you have a lot of dividends or what? I want to understand.
Let's say, so that dividend is an expense. It's an expense.
Let's take it like
Or
that.
liability.
Dividend is supposed to be treated as an expense, but it's just a distribution to the owners of the company.
It's like cash having a debit balance. I just wanted to know what balance you have.
It's a liability. Dividend payout, if you have not paid, it's a liability. Yes. But the paid one is an expense, just like it will be treated as a normal expense. Just to have a debit balance. But in actual fact, it's just a payment to the owners. I get it. That's the major reason why when we are preparing the normal income statement, dividend paid is not part. We will determine our net profit before we go to the retained earnings, which we will consider the dividend paid. Just a distribution to the owners of the company. Okay. It's not a tax deductible expense. I get it. Because if it is a tax deductible expense, then the shareholders will pay themselves higher dividend for the tax liability to come down. Okay.
The tangible non-current asset.
You mentioned taxation.
The taxation charge in the consolidated statement of profit or loss is made up of the following items: corporation tax, deferred taxation, tax attributable to associated undertakings.
So please, what it means is that when we are working for our profit from associates, the tax attributable to associates undertakings will be deducted. And when we are working for the tax paid for the year, we will not use the associate tax because it will be deducted from the associate figure.
The tangible non-current assets of the Bank Group PLC comprise the following.
So please, with the tangible non-current assets, what we need is just addition to the PPE and cash received from the disposal of the PPE. Two things, additions and cash received from the disposal. If you have any depreciation for the year, it has nothing to do with cash. It has been deducted. So what are you supposed to do? You will add it back. Okay. So it's the schedule given to you have depreciation there for the year.
Yeah.
What was the total depreciation for the year? 650. Please, are you all there?
Yes.
So the total depreciation paid for the year. Okay. So we have depreciation. Depreciation paid for the year 650. Okay. What's next? Addition for the year. Please, have you seen the addition for the year? 4,200. So we come here, then we write addition. But with addition, we need only the cash addition. So just don't write the total addition because we are saying addition for the year is 4,200. Don't forget that during the year, they acquired an amount. And that particular subsidiary also came with PPE. So that PPE is included in the addition. So to get the cash addition, that PPE element is supposed to be subtracted. Are we getting it? Please, are we getting it? But if it is a disposal of a subsidiary and that PPE is there, so we have to add it back. Okay, so my 4,200 minus, what was the PPE of plant and machinery or PPE of the subsidiary that is acquired? 330. So that element is supposed to be subtracted. There will be other non-cash additions which we consider later. Okay, do we have a disposal there? What was the cash received from disposing of the assets? We're going to okay, so go to the new subsidiary that we acquired, that is Yamima. The subsidiary that we acquired, that subsidiary came in with a PPE. So that has led to the increases in the PPE. So that element is supposed to be subtracted. Have you seen it? Okay, now we are back to the asset schedule. You realize that depreciation is there. Sorry, disposal is there. And with the disposal, okay, so if you look at the table given, we have disposal under the cost. So what was the cost of the assets that have been disposed? 1,000. Have you seen it? The cost of the assets that have been disposed is 1,000. Then under the depreciation, disposal is also there, and the depreciation or accumulated depreciation of the assets that have been disposed is also 200. Have you seen it? Therefore, the carrying amount of the assets that have been disposed will be 1,000 minus 200, which will be 800. So the carrying amount of the asset that has been disposed will be 800. the 1,000 minus the 200. Are we getting it? And we're told that after disposing of the assets, they had a profit of 300. Profit from the sale of assets. After disposing of the asset, they had a profit of 300. The current amount of the asset that has been disposed is 800. And after disposing of the asset, they had a profit of 300. It means the asset was disposed for how much? 1,100. That is the 300 plus the 800. So you come here and write proceeds from sale of assets. So you can be the 1,000 minus 200 plus the 300, so that you get the 1,100. Okay. So what we need is just two additions and the cash received from the sale of the assets. The next one is note number BR.
Included in the additions, in addition to the plants and machinery are items totaling 1.7 million apart under finance. The plants and machinery disposal resulted in a profit of 300,000.
So that money has been adjusted already. But we are told that included in the addition is 1,705 under finance fees. So is there a cash addition? No. Is that included in the addition is the amount of 1,705 under finance fees. So what it means is that the 1,700 is not a cash addition. And because it's not a cash addition, which has been added to addition, what are you supposed to do? You need to subtract from our addition. Okay. What's next? So we are done with the PPE related items. So which we can calculate it and do the PPE addition figure. Okay, so 2170 is the cash addition, which is the cash outflow when we are buying. Okay. BRI.
Non-sharing liabilities include the following: obligations and the finance fees.
So obligations and the finance fees. The 6% tax there added to the debenture. So it's just a mistake. So the 6% should be part of the debenture. So the debenture will be 6% debenture.
There has been an issue of debentures on 1st August 2015. The account value was 3 million, but they were issued at a discount of 100,000 cedis. The effective rate of interest was 7%.
So because they are issued a debenture, our financing activity is supposed to be affected. So we come here, issue of debenture. It was issued for and at a discount of 100. So the cash received will be 2,900. Okay, now why is it 2,900? But if you look at 2016, the figure is 23. How many cents? If you look at the debenture at the end, instead of the 2,900, it's 2,923. So let's amortize it, because this is a financial instrument, fair value through financial instrument held at amortized cost. So working number 2, debenture. So we have balance at start. So the year will come first. So we just apply the financial instruments format. So we have the year. Because it was issued this year, it's going to be the first year. So our 2016 balance and start. Then we come to effective interest. The effective interest rate was given. What was the effective interest rate? 7. And the coupon. Coupon rate, the rate attached to the bond.
6.
Then we have the balance at end. So what was the balance at start? The 2,900. So that is the bond issue. 7% of 2,900 will be 203. Okay, and the coupon rate, which is the cash flow rate, is always on the nominal value of the bond, and it's supposed to be constant. The nominal value is the same as the par value, so 6% on the 3,000 will be 108. So please let's add. We're going to get 2923, is that correct? 2923, that is the same as the value of the debenture given in the question. And the accounting standard, this is supposed to go to the statement of financial position as they did. But the actual cash received is 2,900. And the cash payment, interest cash payment, is supposed to be 108. That is the coupon payment. But this effective interest is what we go to the income statement when we're learning financial instruments. Okay, financial instrument measured at amortized cost. We know that the figures here will go to the income statement. What is here will go to the cash flow statement. So what it means is that the figure that will be treated in the income statement, it has been overstated by an amount of 23. Are we getting it? Because the cash payment is 180. But because of the accounting standard, what we go to the income statement as a finance cost will be 203. So it means that the interest has been overstated by 23, which is a non-cash item. So when we are working for the interest paid in the form of cash, the interest payable for the year or the finance cost for the year, we're going to subtract 23 from the finance cost for the year. Please, are we getting it? Okay, let me take it again. When you apply the accounting standard, this will go to the income statement as expense. But this is the actual cash paid. The coupon is the actual cash that you pay. Okay, the effective interest or the yield to maturity is the payable. And the payable is supposed to go to the income statement. So if you want to determine the actual interest paid, it's supposed to be 180, not 203. But this is the one that we treated in the income statement. And what we have in the question is the one in the income statement, which has been treated in line with the standard. So what it means is that the 203 was used, not the 108. So if you want to determine the actual cash in the form of interest paid, then it means that you have to reduce it by 23 to reflect the 108. Okay. The next one.
Current liability comprise the following items: trade payables, obligations under finance lease, corporation tax, accrued interest.
Okay, so that is for the current liabilities. Let's move on. Okay, so please, we are done going through the question. So with this, we've been able to treat all the items. So what we're going to do is that we go and adjust the what we have here with three things: inventory, receivables, and payables. Or we go to the current assets, we also go to the current liabilities. So let's start with the current assets. So let's go back to the question and check the current assets. But with the current liabilities is in the footnotes, but the main current assets is in the footnotes. Current assets, these are all there. The first one is inventory. So we're going to look at the movement in cash when it comes to inventory. So inventory, the general principle is that increases in assets is a cash outflow. Decreases in assets is a cash inflow. Are we getting it? Anytime your assets increase, it means that you are buying more assets with cash. Cash will be going out. Decreases in assets means that you are selling the asset for cash. So that is the general principle. Increases in assets is a cash outflow. Decreases in assets is a cash inflow. The opposite is for the equity and the liabilities. Are we getting it? So what it means is that increases in liabilities or increases in equity is a cash inflow. Decreases in liability means cash outflow. So if you have a loan and you are paying the loan, cash will be going out. Your liability will also come down. Okay, so let's start with inventory, which is an asset. What was the inventory balance at the beginning? 2,000.
Yeah.
Okay. During the year, we acquired Nyamima. Nyamima also came in with inventory. So what was the inventory figure there? 64. Okay. It means that our inventory figure is supposed to be 2,064. But what was the balance at the end?
3,930.
It's 3,000.
930.
It means that our asset inventory has increased. It's going to be a cash outflow. One eight. Okay. Next asset. So receivables. Balance at the beginning. 3,550. And we also acquired a subsidiary. The subsidiary came in with inventory of 56. Okay, so if it's a disposal of a subsidiary, this will be minus instead of plus. That's the difference. Are we getting it? Okay. And what's the receivable balance at the end? 3,700. It means it has still increased. 3,700. It's going to be a cash outflow. Okay. So that is inventory, receivables, payables. Let's go to the current liabilities, which is in the footnote. Additional information. The details for the current liabilities are there. The last notes. We have payables. Okay. At the beginning it was during the year they acquired Nyamima. Nyamima also came in with the payables of. But if you look at the Nyamima one, the payable figure is not clearly defined. But we were told that we're given the current liabilities and we're told that included in the current liability is some cash figure. Included in the current liability is a cash of so it means when you subtract the cash figure, the rest becomes payables. Please note that anytime you are giving current liabilities without any description, it is payables. Are we getting it? So included in the current liability is cash. So once you subtract the cash, the rest becomes payables. So what was the payables figure? 174. Okay. So 960 plus 174. Then what was the balance at the end? The payable balance at the end?
Minus the debt.
No, so do that calculation and give me the next one. 140. It's supposed to be
140.
okay. Then the payable figure at the end. But please, if you have any question about that, you need clarification, just draw my attention. That's
The payable there is 170. The current liability is 170. So 136.
136. Okay, that's correct. 136. Then the one at the end is 1,600. So it means it has increased. And increases the liability is a cash inflow, so it's going to be positive. So that would be fine, very well. Good. So please, for the purpose of the exam, we can add everything here together and call it cash generated from operations. But I normally say that if you don't remember the step, just add it together and write the subtotal. Just for that. Right from the that is the payable balance at the beginning. Go to the additional information. The details of the current liabilities are there. The last one. The current liabilities are there. Okay. The total will be that will be yeah. So that's the one. If you have a figure, you can give it to me so that we move on faster. Because you are not supposed to waste time on the calculation. That one you can all do it. The one you have. Okay. 1,139. So that one will be cash generated from operation. Then after this, we will add interest. So we're going to calculate interest paid, which is going to be working number 3. We will calculate cash paid, which is working number 4. So working number 3, interest paid. So let's go to the current liability. Do we have interest owing accruals there?
Yes.
So balance after 60.
Yes.
So that is the interest payable at the beginning. Accruals, interest payable at the beginning, we owe 60. During the year, income statement, let's say the income statement, the interest payable, it was 300. And we're saying that that 300 includes a non-cash of 23. Okay?
That explanation will include.
It don't clear to you. Let me explain so that you understand. Okay. Well, this one, we have the coupon payment and effective interest. Anytime you issue coupon, the coupon payment becomes what you actually pay in a form of cash. So in this case, what you actually pay in the form of cash will be 1/8, that is the coupon. Are you getting it? Then the effective interest is just accounting calculation. And that one is supposed to be treated in the income statement. Are you getting it? So what you actually pay for the year is supposed to be 1/8, but because of accounting reasons, what is going to the income statement, because you don't need the cash statement to refer in the income statement, you need the accrual. So what is going to the income statement is 203. So it means that what is going to the income statement, it includes non-cash item of 23. I get it. So it includes non-cash item of 23, and that's the major reason why we are subtracting 23 from the one in the income statement. Good. So it's going to be 300 minus Okay. Then 60 plus 277 will be 300. So balance at end. 8 years. So interest paid will be 200. So the interest paid is 257. We will say for tax paid. Income tax paid. Workings number 4. So W for income tax paid. Balance at start. So please, with the income tax, we're going to apply IAS 12. And with the tax standard, we have the current tax, the deferred tax, and the under tax provision, 3 things. So when you are working or you are determining the balance at start, don't use only the current tax and the current liabilities. Go to the non-current liabilities, there can be deferred tax there. And add the two balance at the beginning together before you go to the one in the income statement and the balance at the end. Are we getting it? So let's check our current liabilities. So what's the deferred tax balance at the current tax balance at the beginning? We have income tax there.
Yes.
The one at the beginning is
26.
check.
Which one are you checking for me? Consolidated.
But you have, I'm talking about, we are starting with the current one. What is in the current liabilities?
134.
If you check the page 4, it's there. Corporation tax. 2015, that's the one at the beginning. It's 434. How is it? So that one is 434. Then you go to the non-current liabilities in the main question. The main question, non-current liabilities. Under provision for liabilities, have you seen deferred taxation?
Yeah.
The one at the beginning there is 26. That is the one you mentioned there. So that is plus 26. So the beginning one will be okay. Then in the income statement, what was the corporation tax? But we were told that the one in the income statement, we were given the division in note number 2 or 2. No, note number 5. Taxation charge in the consolidated profit or loss is made up of the following items. We have the corporation tax, the fair tax, and the last one is the tax attributable to the associates. We will not add the tax attributable to the associates, but when we are doing adjustment for associates, we will deduct their own taxation. So in the income statement, we're going to consider 782 plus 20. So it's normal, the format is like this: beginning, income statement, subsidiary, then the one at the end. It's always like that: beginning, income statement, subsidiary, one at the end. Sometimes the beginning, income statement at the end. Sometimes beginning, subsidiary, one at the end. Just like the current liabilities and the current 990. During the year, we acquire a subsidiary, Nyamima. Let's find out whether Nyamima also pays me the tax. Because I heard you say that it's the current liability includes some tax. 34. Okay, so the balance starts to be, or the balance at the end is supposed to be. So we're going to compare it to the one at the end. 1,100. Okay, so let's repeat the same process. What was the balance at the end for the taxation? In the current liabilities, 924. Then in the non-current liabilities, in the statement of financial the total will be 984. Which means that we have paid the liability and that we paid. We pay 500. The income tax paid is 500. Next is determined. So it's going to be net cash flow. that would be. Okay, so please, we are done with the operating activities. Now let's move on to investing and financing. My advice is that after this question, try and solve it like 2 times. Same question. Solve the same question for about 2 times. Be familiar with the process. It's the same thing. When the question is given to you in the exam, you follow the same procedure. There will be small changes. And if you're able to apply what you are learning here, if it's 20, you can easily get 19 or 18 out of the 20. And if you are getting 19 from consolidation, it means you have already passed the exam. Okay. So let's move on to investing. Please, when you get to investing activities, concentrate on owning on current assets. So go to the statement of financial position and look for owning on current assets. So just go straight to owning on current assets. So under non-current assets, the first item is tangible assets. Have you seen it? The first one is, intangible. Intangible, at the beginning it was 0. At the end it's 200. Please, have you seen it? At the beginning 0, at the end is 200. So that 200, we compare it to the goodwill. You realize that the 200 is goodwill. It means that there is no changes in cash. But if at the end is 500 and goodwill is 200, it means that they have acquired additional intangible assets for 300. So you write addition to intangible assets, 300. But because the goodwill is equal to the intangible asset figure, no adjustment. Is already getting it. Then the next one is tangible assets. So the tangible, that is the schedule given to us. That one we've done it. Additions and proceeds from sale. So it has been done. The T account. Yes, you can do that when you are not giving the detail. I get it. If you are not giving the detail, that is where you worry ahead to do the T account. So balance at the beginning will be at the debit side, credit side for the closing, depreciation debit, carrying amount of the asset that have been disposed is going to be at the credit side, and the difference is going to be additions. But in this particular question, they have prepared it and given you the additions. So once the addition is given to you, just subtract the non-cash additions and that's it. But if the addition is not given directly, that is where you apply the T account. Are you getting it? Are you getting it? So the T account is very important. If you are not giving the addition directly, you can use the T account or you can use this approach. Even with this one, you can still use T account to do it. Are you getting it? But the simple approach is this one. That is, but if you are comfortable with T account, you just write interest payable. It's a liability. So the balance will be at the credit side. And the balance sheet will be at the debit side. Then the income statement, because it's at the debit, the corresponding entry will go to the credit. Then you do the adjustment and realize that you get the same 257. If you try the T account, you're going to get the same answer. But you can use this for the T account, whichever is better for you. Okay. We have investments in associates undertakings. Is everything it? Investment in associates undertakings. So you just write or call it dividend from associates. Dividend from associates. Which is going to be working. So working number 5. So W5. Dividend from associates. So the dividend from associates, balance sheet. So with this one, you can use the T account because it's an asset. The balance sheet is debited, the balance sheet is credited. You can also do it directly without the T account. So what's the balance at the beginning? Balance at start is at beginning. Balance at start. Balance at start is 2,000. Then associates, dividend from associates. Okay. So income statement. In the income statement, we have profit from associates undertaking. Have you seen it? Yes. So we will add it. What was the profit from associates? 990. I told you that we're going to subtract it because we're adding it here. Then associates also came with its own tax. What was the associate tax, which we need add to the main tax? 355. That is the associate tax. Okay. So that is the associate tax. Then after the associate tax.
So the first aspect, where did you get it?
Investments in associates. At the beginning is 2,000 or not 200.
I can't see the
non-current assets. I told you that with the investing activities, concentrate on non-current assets. Page 2, non-current assets. Investment in associates undertakings. Have you seen it? Okay, so please let's add. Now let's note this. during the year, if they acquire an associate during the year, then that one too will be investment in associates will be added. I get it. Additional associates acquired during the year will be added before we convert the one at the end. But if you look at this particular question, the associate was acquired several years ago. Okay, please, let's add 2, 3, 3. Okay, then balance at end. Balance at end is 2,200. So we are getting dividend of 435. So the asset has decreased. So that is cash received. Dividend from associates is 435. Then after dividend from associates, if you look at the question, we have other investments. Have you seen the other investments? Balance at the beginning and balance at the end is the same thing. So no changes. Please have you seen it? Balance at the beginning is the same as the balance at the end. So what it means is that we are done with the investing activity. So let's have cash from investing activities or net cash flow from investing activities. Sorry, the interest is still. Yes, it's good. It is there, but we've not added the figure. The figure is 808. So it's going to be. Now you gave me that figure. I had to say it was I wrote it. I said the next cash flow. So this is going to be the next cash flow from investing. Investing activity. 300. Then the financing activities. So the financing activities, we're going to look at the long-term liabilities and equity only. Are you getting the trend? When you get to investing activities, non-current assets only, then you add interest received. When you get to financing activities, long-term liabilities and equity. Long-term liabilities and equity. Good. So let's start with the long-term liabilities. When we finish, we'll come to equity. Or we can start with the equity and later look at the long-term liabilities. Okay, let's look at the long-term liabilities first. Current liability. Okay. Let me check the main question and see which one is starting. Okay. Current total assets. Yes, non-current liabilities. This non-current liabilities is in the form of footnotes. Have you seen it? The non-current liabilities. If you look at page 2, non-current liabilities, the total figures is there, with the exception of the deferred taxation which have been treated. The other one is in the form of footnotes. So let's go and check what is under non-current liability. Note number VII, page 4, is there. The first one is the obligations and the finances. And the second one is the issue of the debenture. So the issue of the debenture, we already have it here. Okay, that is the issue of debenture. We have it here. So what we're going to add is the finances. So we just write finances. Then we're going to be working number 6. So we have question number 6, finance fees. So please with the finance list, the balance as start, you have a figure in the current liabilities, you also have a figure in the non-current liabilities. You add the start figures together. Are we getting it? So what was the balance at start for the finance list?
400.
Which of them? The current or the non-current? Because I can see 1430 here. 1340. Well, that is the non-current. And the current one is 400. Good. So the balance BD will be. The finance list, there are two. One is the current liabilities, one is the non-current liabilities.
1740.
1740. Then BP, during the year, there are 5 BP items, 1,700. Do you remember? Note number BI. Included in addition to BP, plant and machinery are items totaling 1,700 acquired under finance list. So that one will be added. Then, please the two added together will be
3440.
3440. Then balance as n. Let's follow the same process as at the beginning. At the end, we have 1417 plus finance is 408. Finances, 2016. I mean, page 4. We are all there. 1 8. So page will be 1543. Now the question is, how do you know whether it's a cash inflow or a cash outflow? Okay, I've already informed you that if it is a liability or equity item, when it increases, it means it's possible cash inflow. When it decreases, it means that it's a cash outflow. Are you getting it? If it is assets, when it increases, it's a cash outflow. When it decreases, it's a cash inflow. So this one, what has happened to the liability? So it means that it's a cash outflow, it's paid. The financial statement is 1543. Okay, so that is for the liabilities. Let's move on to the equity. Under the equity, the first item there is share capital. Have you seen it? Main question, page 2. Under equity, the first item there is share capital. So we just write share capital. Writing number 7. Share capital. So the share capital, we're going to add a capital surplus balance and the actual balance at start. So what was the share capital balance at start? Then we add a capital surplus. The retained earnings is the same as the profit, so we not add it. So the capital surplus of 4190 will be added. So that one will be. Then, during the year, we acquire a subsidiary through a share estate. And what was the share estate figure? Okay, so the total will be 8742. The balance at end, the same thing, 7880 plus
3646.
So issue, it has increased. So if you have issue shares for cash. 4,906. It means we have issue shares for cash. So share capital Because liability for equity has increased, it means that cash is coming in. What's next? We are still on equity, retained earnings. That one is in profits. These are which is the last equity item, the non-controlling interest. So we call it cash paid to NCI or non-controlling interest, which is going to be working number 8. Cash paid NCI. So balance BE, balance and start. What was the NCI balance at the beginning?
0.
Okay, so cash. Then income statement. Let's go to the income statement. Profit attributable to the NCI. What was the profit attributable to the NCI? Are you sure that one is for NCI?
200.
The NCI is 200. The 24 something is for the group members. Then, okay. We move on to profit attributable to NCI is 200. Then during the year, we acquired a subsidiary, it was 100% acquisition. It was 75. Therefore, NCI will be so 25% of the equity, 504. So NCI will be 326. Then balance as N. What was the NCI balance as N? What has happened to the liability has increased. That's why we are saying that it's cash paid to NCI. So the pay will be 100 or 90 something. 96 or 94. Okay, so net cash flow from financing will be now let's add the three figures together. 1, 2, 3 added together. That one will be net. I think it's going to be positive. So net increase in cash and cash equivalent. If it is negative, you call it net increase in cash and cash equivalent. The net increase in cash and cash equivalent will be 5,309. Then opening cash and cash. Okay, so what was the cash? Please, with the cash and cash equivalent, in the exam we'll be checking 3 things: cash in hand, cash account, and short-term investment. But in this particular question, it's only one. Okay. So let's go to the current assets. And sometimes we check the current liability for bank overdraft to be there, which is part of the cash and cash equivalent. Are we getting it? The bank balance can be positive, it can also be negative. Please watch. Today is giving you have to watch. Okay. Yes. So it's going to be opening cash and cash equivalent. Opening will be current assets, cash at bank and in hand. a fair balance. This closing cash and cash equivalent is addition of these two. But it's also given to you. So I advise that you write the one given to you. But when you add, you get the same answer. When you add and you get the same answer, it means that everything is correct. So let's write the one given here, which is 90 days. But let's add and confirm.
92.
It's the same thing. So it means that everything is correct. So once we've been able to confirm, it means that everything is right. Good. A lot of work. Let's solve it like 2 times. And I'm very sure we can. Bank and machinery of the subsidiary, which one?
330.
Okay, this one. Yes. We wanted to get actual cash additions. We were told that the total additions for the year was 4,200. So that 4,200, how do we determine the actual cash additions? The 330 was from the subsidiary that we acquired. It has increased the PPE. It's part of the addition, but is it cash addition? No. We didn't buy it because the subsidiary came in with those items. So we are looking for the actual cash. That's elementary. And we deducted it because it was acquired through the finances. We didn't pay cash. So that's elementary. Okay, so let's look at some of the questions. Let's go straight to page number 16. Mahadi Limited. So let's check page number 16. Page 16, okay. Okay, so please you read the question for us to solve it together.
Position of Mahadi Limited after the reconstruction on assumption that proposal 2 is adopted and implemented.
Okay, so we are looking at Mahadi Limited. So proposal 1 is there, and we also look at the amount that Mahadi Limited will get if the company is to wound up or go on liquidation. Okay. And B part is the preparation of the new statement of financial affairs. So take the question again so that we go through it. Question number.
Profitably in Ghana for several years, but now facing financial difficulties after recording losses in its operations recently. The company's statement of financial position as at 30 September 2019 is even below. Additional information.
Okay.
Mahadi Limited operates a number of retail.
I'll share, I think it has been shared on the platform. Are you on the platform? Okay, then probably we have to research so that we will to get it. Now let me read that side for you. They are not done. Okay.
Mahadi Limited operates a number of retail outlets for snack bars. Most of these outlets are rented out. The company's largest supplier is Banda Limited, which holds all of the venture stores and is also a trade creditor for 240,000, included in sundry payables above.
So Mahadi is, you want to look at the position of Mahadi. So please take the note number 1 again. The credit card. Because we are to determine amount Mahadi Limited will get if the company is to move out.
Mahadi Limited operates a number of retail outlets for snack bars. Most of these outlets are rented out. The company's largest supplier is Banda Limited, which holds all of the debenture stores. And
so Banda Limited holds all the debenture stores. So the debenture is from Banda. What's next?
And is also a trade creditor for 240,000, included in sundry payables above.
Okay, so he also owns the trade. Okay.
Included in the sundry payables are preferential payables of 44,000 cedis.
So with the sundry payables, 44,000 is preferential. What it means is that after paying the debt secure with the first charge and paying any liquidation costs, we need to pay the preferential payments or any other statutory payments.
The bank overdraft from Northern Rock Bank is secured by a fixed charge over the freehold property of Mahadi Limited.
So the bank overdraft is a debt secured with a fixed charge. So when we are paying, that one is supposed to be number 1. Are we getting it? It's supposed to be number 1. Debt secured with a fixed charge is supposed to be number 1. And it was secured against which asset? The freehold premises. So we look at selling the freehold premises and whatever difference we use to pay. If we sell it and the amount realized is lower than the debt, we pay that amount. If it is more than the debt, if the debt is more than that amount, the difference becomes the unsecured debt. So when we get to the payment of the unsecured debt, we will add it and pay. Okay.
And the debenture stock is secured by a floating charge over the company's
So with the debenture, it's a debt secured with a floating charge. So that one will be paid before we pay the unsecured debt holders.
On October 1st, 2019,
Okay.
Mahadi Limited has scheduled a meeting of all the stakeholders of the company in order to consider the following alternative proposals. 1. The management of Mahadi Limited
So that is proposal 1.
proposes for the immediate liquidation of the company, which would result in the following estimated amount for realized assets.
Okay, so let's do it together. So we will determine the realizable amount of the following assets. Okay. So we come here and let's finish with. Let's finish. We are using proposal 1 for solution number 1. Then we use proposal 2 for solution number 2. Are we getting it?
Is it always the norm, the practice that this form of person is
Yes. For capital reduction. Sorry, for capital reduction and reconstruction scheme, we have 2 parts. We have where you are giving a scheme. Are you getting it? For you to prepare the account. That one is scheme. Then you prepare the account, the capital reduction and those things. And the second part is scheme design. The scheme design will come like this. So if the company is to go on liquidation, what will happen? Then the new statement of financial position. And the other part is the one that we saw in class, where you are giving the person, you prepare the capital reduction account, you prepare the bank account, and you prepare the new statement of financial position. Okay. I think that one is starting the class. Okay. And it's making affect those on. Okay, so let's do it together. We are starting with the A. Show the total amount Banda Limited will receive in case of liquidation of Mahadi Limited proposal 1. Are we getting it? So forget about Banda Limited for now and determine the liquidation position. When we finish, we will determine amount Banda Limited will get. So for liquidation position, we're going to sell all the assets. So let's go back to the question. What are the assets? I think there are 3. Freehold property, equipment, and inventory. Okay. So liquidation, position, and distribution. So I want to call it liquidation, position, and distribution. Okay. So sale of assets or realizable amount. So you're going to sell all the assets and share the money. So selling the freehold property, what will be the realizable amount? When we sell the freehold property, we're going to get 50 million. Okay. When we sell the equipment, we will get. So please pay attention to questions like this. When you give it, you have to score everything. Within 10 minutes, you have to finish and get all the 15 marks. So, equipment, inventory. So, total will be. So we're going to share this 300,000. So distribution. So with the distribution, we will start with debt secure with the fixed charge. Which of the debt was secure with the fixed charge? By the question. Which of the debt was secure with the fixed charge? The bank overdraft was secure with the fixed charge. That is number 1. So we are starting with debt secure with the fixed charge. So we have to pay the bank overdraft first. What was the bank overdraft figure?
68,000.
The bank overdraft, 68,000. It was secured against which assets? The bank overdraft is a debt secured with a fixed charge, which is supposed to be paid as number one, and it was secured against which assets? And the actual liability is 68,000. So when they sell the freehold property, what was the amount realized?
56,000.
Even though the actual bank overdraft is 68, but it was secured against freehold property. But after selling the freehold property, they had 56,000. We have to pay the 56,000. Okay. Then the difference between the two will be added to the payment of the unsecured debt holders. I get it. So instead of paying all the 68,000, because it was secured against this asset, and after selling the asset, we have 56. We will pay the 56. But that doesn't mean that we will not pay the difference. The difference will be paid when we are paying the unsecured debt holders. So what will be the difference? 12,000. So please calculate it and write it somewhere. We will pay that difference when we are paying the unsecured debt holders. Good. So that's a bank overdraft, number one. That's a debt secured with a fixed charge. Then after debt secured with a fixed charge, we move on to liquidation costs and then any preferential or statutory payments. Do you have preferential or statutory payments? That is, by the question we're told that included in the sundry payables are preferential payables of 44,000, an amount due to GRA. So the GRA amount is 44,000. So which is from the sundry payables. So we have been able to pay debt secure with that's preferential. Then we move on to debt secure with the floating charge. Which of the debt was secure with the floating charge? So the debenture. That one we pay everything because it's secure with the floating charge. So the debenture was the debt secure with the floating charge. So what was the debenture amount? 48,000. We pay all the debenture. How you get it? Please let's add and deduct. Total will be
148.
148,000. So we're going to determine amount available to unsecured holders. So what will be the amount available to them? 153,000. So we're going to use the 153,000 to pay our unsecured debt holders. So let's list them. So we go back to the question and check our payables, people that we're supposed to pay. I can see then the debenture we pay. We also pay. Okay, let me start with the bank overdraft. With the bank overdraft, we did pay all the figure. We paid 56, but the total was 68. So we have a balance of 12,000 to pay. Then the sundry payables, it was 412,000. Okay, but 44,000 was included, which we have already paid. So sundry payables. Sundry payables, we will pay an amount of 412 minus the GRA payment. 368. Okay. So if you look at the bank overdraft, yes, the difference is there. The other liability is the debenture, which we have paid everything. Okay. So let's add these two figures together. 380,000. We're at 380,000. But the amount available to pay them is only 150. So we cannot pay them. So we determine the payout. So in the exam, we write the payout. So the payout will be 152,000 divided by 380,000. So it's going to be 0.4. So it states that, please, at this point, you have to write small notes in the exam. It states that when the company go on liquidation, one Ghana cedi unsecured debt holder, one Ghana cedi unsecured debt holder will receive 40 pesos. If you are one Ghana cedi unsecured debt holder, you're going to receive 40 pesos. Are you getting it? So when the company go on liquidation, one Ghana cedi unsecured debt holder will receive 40 pesos. However, the preference shareholders and ordinary shareholders will not receive any amount. Are you getting it? So that if the company goes on liquidation, one Ghana cedi unsecured debt holder will receive 40 pesos. However, the preference shareholders and ordinary shareholders will not receive any amount. So if you are one Ghana cedi unsecured debt holder, you will get 40 pesos. Okay. Now, the requirement is not talking about this. The requirement is saying we should determine amount Banda Limited will get if the company is to go on liquidation. Are we getting it? So let's determine allocation to Banda. Allocation to Banda. So let's find out who is Banda. Who is Banda? If you read I, the company largest supplier is Banda Limited, which holds all the debenture stock. So the Banda Limited, the debenture belongs to Banda. So what it means is that if the company is to go on liquidation, debenture, Banda Limited will get 48,000 from the debenture. Are we getting it? And it's also a trade creditor of 240,000 included in the sundry payables above. So, sundry payables. And with the sundry payables, they are part of the unsecured debt holders. And they are saying that if you have one seed, we will give you 40 pesos. So with the 240,000, Banda Limited will give you 240,000 times 0.4. Because if you have one seed, we will give you 40 pesos. So we give 96. So if the company go on liquidation, Banda Limited will get 48 plus 96. 144.
Yes.
Okay, so that is the first part. I. When the company is to go on liquidation, Banda Limited will get 144,000. Please, are you following? Because Banda Limited owns the debenture. He also owns 240 of the payables here. With the payables, if you have one, you will give you 40 pesos. B. Now let's move on to proposal 2, because the B is the financial position after the scheme design. Proposal 2B.
Banda Limited has made an offer of support which would allow the reconstruction of Mahadi Limited to continue to operate as a going concern. Under this reconstruction arrangement, the debentures left by Banda Limited will be converted into 48,000 ordinary shares.
So please, because we're going to prepare a new statement of financial position, you have to link it to what you'll be doing, because you're going to answer the question in line with the requirement. We are saying that the 48,000 ordinary shares, the debenture owned by Banda, what will happen? They're going to convert all the debenture into 48,000 100 shares. Which are we getting it? So what it means is that when we are preparing the new statement of financial position, there will be no debenture. Everything will be converted to ordinary shares. Which are we getting it? There will be no debenture. But the number of shares in the company will increase. Are we getting it? So the number of shares, let me with some workings here. Can I clean this part? Can I clean that? So we're going to have small workings for the number of shares. So please, if it is exam, you just write workings number 1, share capital. And see the addition. Debenture will now be shares. It will be converted to a share of 48,000. Okay. So please, what you do is that you go back to the question and cancel the debenture. And in your workings, you write the 48,000 so that when you are preparing the new statement of financial position, it will be copy back. How you getting it? Good. What's next?
Issued at 1 CD per share, and for every 200 CDs of 240,000 traded at Old Banda Limited, there would be issued 110 ordinary shares at 1 CD each in the reconstructed company. The balance of the trade debt owed to Banda Limited will be written off against the equipment of Mahati Limited.
So this is 2 in 1. So they are saying that, Banda Limited also owns 240,000 of the trade, the sundry payables or the trade payables. And they are saying that with the 240, every 200 of the 240,000 will be converted to how many shares? 110. Are you getting it? So what it means is that let's do small ratio and proportions to determine the number of shares conversion. So for every 200 Ghana cedis, they will be giving how many shares? 110. Are you getting it? For every 200 Ghana cedis, they will be giving 210. So how many shares will be given for the 240,000 Ghana cedis? So it's going to be 240,000 times 110 cross multiplication divided by 200. So we just apply small mathematics here. Are we getting it? So we don't know this. Let's calculate it. So it will be converted to how many shares? $200 Ghana cedis will be given 110 shares. Therefore, 240,000, how many shares will be given to you? So please just apply the example. You had 240,000.
132.
So, sundry payables or mandat will now be converted to how many shares? 152 times 1, so it will be 132,000 Ghana cedis. Now, what was the old share capital? 240,000. And we have converted it to 133,000. So there will be a balance. So what will be the balance? The balance will be 108. So that balance of 108, we are saying that that's 108. Go and write it off against the equipment. Okay, we were told that, and the balance of the trade debt owed to Banda will be written off against equipment of Mahadi Limited. So where do we have the equipment? So we go back to the main question. What was the equipment figure? So minus 108. So just write minus 108 attached to the question. So that when you are doing the presentation, you will not forget. So minus 108. Is have we done that? So where the equipment figure is, the 468, you just write minus 108,000. So that you will not forget. Okay. What next? Good.
Is Banda's debt not 240?
240, yes.
And we have converted all to shares.
But when you convert it to shares,
the amount
is 132.
Okay.
You get it? So there will be difference. So that difference is,
So you subtract the 162 from the 240.
excellent. So that difference of 10 something, we are saying that it should be charged against the the equipment figure. If they don't say anything about it, what we do is that we take it as an increase in the company's equity. We go and increase our retained earnings with that figure. Okay, what next?
Mahari Limited existing shareholders would receive one ordinary share in the reconstructed company, credited as to 1 cedi per share, in exchange for every 5% free merit.
Okay, so what it means is that existing shareholders, existing share. Okay, so what it means is that with the existing shares, if you have 5, they will give you only 1. Because we want to do reconstruction, we want to reduce our capital. If you have 5 shares, you are going to be given only 1. How many shares were there? Share capital stated. How many shares? I think it was 400,000. Even though the price was 0.25, but it was 400,000 shares. Please have you seen it?
Yes.
400,000. And if you have 5, they will give you 1. So 1 over 5 times 400,000 will be
80.
it's going to be 80,000. Are you getting it? And that 80,000, the price per one will be 1 cedi. So 80,000 times 1 will still be there. 80,000. Okay, page 16. Equity and liabilities. Share capital. 400,000 ordinary shares issued at 25 express. So it's still 80,000. Please, what has happened? What was the share capital, the total share capital in the question?
100,000.
And we have changed from 100,000 to what now?
80,000.
So there will be a difference of 20,000, which is a capital reduction. How you getting it? So please, this 20,000, the examiner will be silent on it. But you should know as an accountant that if you don't treat it, it will not balance. And because it's a capital reduction, it will go and increase your equity, your retained earnings. Are you getting it? When we prepare the capital reduction account, what happens is that it will go and increase the company's equity. Please, are you getting it? So that's 20,000. What we will do is that we will go and change our equity with the 20,000. Okay, so please, what was the retained earnings balance in the question?
40,000. The deficit of
It's a deficit of 40,000, have you seen it? And because we have a positive 20,000, we're going to reduce the deficit. What will be the new deficit?
20,000.
So please note it. So the 40,000, that's right, minus 20. So that the new one will be only 20,000. And what's next?
The balance of the retained earnings is not absorbed by the existing shareholders. And it will be
Because
reckoned-
everything didn't absorb. It was 20,000, we have reduced it by only 20,000. So what are we going to do?
and it will be written off against the capital surplus.
So let's do that mathematics. We have to write it off against the capital surplus. What was the capital surplus figure?
68,000.
So we're going to write off what figure from the 68,000?
24.
Which are we getting it?
Is it the same 20,000 like
The remaining 20,000.
but we said that we will set it against the retained earnings.
No, take that line again. We were told that. That one, the 20,000, we set it against the retained earnings figure. That was 40,000.
Yes.
So when we set it against it, what will be the remaining figure?
Minus 20.
Minus 20. And the examiner is telling you that the existing shareholders didn't take everything. So we should be set it off against the capital surplus. That is what is here. Okay, because we are told that the balance on the retained earnings is not absorbed by the existing shareholders in the share exchange above because there was a remaining figure of 20,000. Okay, and it is
You
to
don't
be
think you
read.
said the 20,000.
Which of the 20,000? Okay, but let me take this again. The balance on the retained earnings is not absorbed by the existing shareholders and is to be written off against the capital surplus. I get it. Which means that the retained earnings figure will be written off against the capital surplus. Good. Now we are saying that with the existing shareholders, when we did the mathematics, what figure did we get?
20,000.
We had 8. And what was the share capital in the question?
100,000.
100,000. So it means that they will absorb 20,000 of the retained earnings. So the retained earnings figure was negative 40,000. So if they absorb 20,000, the remaining retained earnings figure will be only 20,000. And that remaining figure, we are saying that set it off against the capital surplus. Are we getting it? So what I'm trying to say is that in our new solution, we will cancel the retained earnings line. The negative retained earnings will go away. But the capital surplus figure will now be 68,000 minus 20,000. Are we getting it? What's next?
The fair value cost of the freehold property and inventories approximates their carrying value.
So it means that we will not change the values. We're not going to use the sale value to represent the new value. We're going to use the old value.
An additional 140,000 ordinary shares in Mahadi Limited would be issued to Banda for cash consideration of 140,000.
So the cash figure, the number of shares will also increase by 140,000. So please, if you want to complete the double entry where you have a current asset, go and write cash and write 140,000. We are injecting cash. So cash will come in 140,000. And the number of shares will increase by 140,000. Are we getting it? What's next? Because we are done with the question.
In order to improve the liquidity position of the reconstructed entity, it has been estimated by the management of Banda Limited that after reconstruction, Mahadi Limited will earn regular net profit of 54,000 per annum.
Okay, so they will earn regular net profit of 54,000 per annum. Please, anytime you do reconstruction is supposed to lead to a promising future. Are you getting it? It should lead to a promising future. And that's the major reason why we are saying that every year their profit figure will increase by 140,000. It will not affect your calculation. Any design should lead to a promising future. What's next? Okay, so we are done.
Other irrelevant situation. Is it not important?
Okay. So read it. Read the other relevant information.
Ignore reconstruction and liquidation expenses. Assume that Banda Limited can currently earn 15% per annum on new investments involving similar risks to those which will be incurred by investing in Mahadi Limited. Assume that the adopted proposal will be implemented immediately.
Okay, so please, so clearly, those information are not important in this question. We are to prepare, second requirement, we are to prepare a statement of financial position after the report is that is the reconstruction or proposed Mahadi. So Mahadi LTD statement of financial position as at what date? 30th of September 2019. 30th of September 2019. So we have assets. The Ghana CEO of assets. So just follow the same format. It's just a copy back. Non-current assets. What do we have? The first item there is freehold profits. I don't think we did any adjustment against this figure. So it's still the 68,000. Just a copy back. Equipment. I think for equipment there's adjustments. 468 minus what?
108.
I told you to do that adjustment minus 108. The next figure will be 360,000. So total concurrent will be
428.
okay. Then we move on to current assets. The current assets we have inventories. Immediate editing on inventories. 120,000. But we have introduction of cash of 140, so making 260,000. Total assets will be
688.
Then we have equity and liability. So under equity and liabilities, stated capital. So what will be the capital? The new share capital. One.
Yes.
Capital surplus will be 68,000 minus 20, 48,000. Then and 0. The debenture is for Mahadi, which have been converted to shares. And then payables. Sundry payables. So please, with the payables, out of 412,000, Mahadi owns 200, which have been converted. 240, right? So it's going to be 170. Okay. Then the last one is bank overdraft. He is on it, so 8,000. So you add, and we are expected to get this. So please let's add and confirm.
The bank was 58 now.
68. That's the one in the question. Now, each and so that's it.
The one with it, November, is from bring the equipment.
But yes. But you wrote it on my question paper.
Yes, so how come you got it to what
So what made you to write it? Yeah, I understand, yes. Maybe you have forgotten or something. When did we converted the 250,000 to or 240,000 to shares? We had 132,000. So when you subtract the 132 from the 240, you get the 130. Are you getting it now?
Yeah.
You know, Mahadi was having 240,000 payables, which were to do ratio and proportion and convert to shares. So when we did that conversion, we had 132,000. Okay, but the actual figure was 240. So we were told that the difference in the ratio of against the rate. So 240 minus 132 gave me the 130. Okay, so please, can I clean it for us to move on? Some of the questions we will just discuss it without solving any question. Okay, so let's look at one other question around this area. Question number 12. Question number 10, page 12. So when we finish, we look at the edges. So look at interpretation. So we discuss ethics interpretation. We discuss ethics interpretation. Then we go for break maybe around 1:30. And come back and look at the other areas. So question number.
Determine the value to be placed on each share of power limited using the following methods of valuation. Power Limited operates a large-scale commercial farm. It now plans to offload some of its shareholding to the public in order to raise funds to expand its operations. Financial statements of Power Limited are as follows. Statement of comprehensive income for the year 31st December 2016. Income surplus accounts. Statement of financial position as at 31st December 2016. Additional information. Stated capital is made up as follows. Ordinary shares issued at 20% each. 22% in
Okay, so what will be the number of ordinary shares? So let's calculate the number. 80,000 divided by 0.2 will be. So it's going to be 400,000. Okay. These are you all getting it? Okay.
A review of the development expenditure revealed that 60% of it is worthless.
So please let's calculate 60% of the development expenditure. So 60% of the development expenditure is worthless. So 0.6 of the development expenditure. So when we are working it, 0.6 of it will not be considered because it's worthless. It does not have any value.
An independent valuer has placed values on some of the assets, detailed as follows. Plans.
So please, what we're going to do now is that we're going to write the new figures attached to the old one. So let's write the new figures attached to the old one. We are saying that PPE now will be
223. Inventory.
Now will be
400.
receivables now will be
20,000.
okay.
Profit forecast for the next 5 years as follows.
For the next, okay, so we have profit before tax, then depreciation charge. Okay.
The estimated profit before tax figures are arrived at after charging the estimated depreciation.
Yeah, the profits are arrived at after charging the depreciation. Please, this note is key. Sometimes the examiner will tell you that the profits are before charging depreciation. If it is before, it means that they have not charged depreciation. Therefore, we don't charge depreciation. After charging depreciation means that they have already deducted depreciation. So what are we going to do? We will add the depreciation back because depreciation is a non-cash expense. So if it has been deducted, what we're going to do is that we will add it back. Okay.
Yam Limited is a competitor listed on the Ghana Stock Exchange, and data extracted from its recently published statements reveal the following.
So what we need from the listed company is their PE ratio and their dividend yield. And it's not given directly, but we are giving information to calculate the PE ratio and the dividend yield from the listed company.
Note 6.
So we have the market capitalization, which is the market price per share multiplied by the number of shares. That will give us the market capitalization. Then the number of shares is given. So we can get the market price per share from the listed company.
The patent represents a license to produce an improved variety of potatoes and is expected to generate a pre-tax profit of 20,000 per year for the next 5 years.
So please, if it is 20,000 per year for the next 5 years, that is annuity 5 years. So you use the annuity factor 5 years. But if it is 20,000 up to infinity, then it's going to be the 20,000 divided by the cost of capital. Are we getting it? But if it is for the next 5 years, it means that annuity 5 years, every year for the next 5 years. But if it is 20,000 for only year 5, that one will be 20,000 present value year 5. Are we getting it? Annuity means that every year for the next 5 years, that is the annuity factor. But if it is 20,000 for only year 5, then we use the present or the discount factor for only year 5. So with this one, we're going to use the annuity year 5. If you look at the question, the annuity table has been attached. So what is the annuity year 5? It's 3.125. If it is not given to you, you can use your calculator to determine the annuity factor, which is very simple. So the cost of capital is 18%. So 1 equal to divided by 1.18 equal to 5 times. You just add the figures together. You have the annuity 5 years. So let's calculate the patent figure. So the patent figure will be the new patent figure will be 20,000 times annuity 5 years. That is 3.127. Okay. What will be the patent figure? Okay, so please, when you have patents, you will write this figure attached to the patent figure so that when we are working for the next assessment, it becomes very simple. But let's do small workings before we move on to the actual requirements. We have the listed company information, that's Yam Limited. What we need is the PE ratio and their dividend yield. So let's, in most cases, it will be given to you, but if it is not given, that is what we're going to use. So we need the dividend yield and the PE ratio. The PE ratio of the listed company is market price per share divided by earnings per share. We give you the PE ratio. But if you look at the data given, we have the price, the earnings per share, but we don't have the market price per share. Please, are you following? So let's determine the market price per share. And we know the market capitalization to be equal to market price per share multiplied by the number of shares. And by the question, we're told that the market capitalization is 2 million. We don't know the market price per share, but we know the number share fee. 800,000. Okay. So mathematically, what will be the market price per share of the listed company? 2 million divided by 800,000 will be 2.5. So that is the market price per share. MPS is 2.5. So let's determine the P ratio. So the P ratio will be PE ratio is going to be 2.5 divided by the earnings per share of 0.2. So P ratio will be 12.5. Okay, so please, in most cases, the examiner will tell you that it is about 30% risk in investing in unlisted company. That one, the risk factor is given to you. So when you do your calculation, you reduce it by the risk factor or you increase it by the risk factor. But in this particular question, the examiner is silent on the risk factor. So you have to determine your own risk. So you can choose any rate between 10 to 40%. How you get it? It all depends on you. So with this one, you can say that reduce by 20%. So that we take 80% of it. So reduce by 20% will be going to be 2.5. They are reducing by 2.5. So the P ratio that will be used in our calculation will be 10. It's permitted. Somebody can say reduce by 30%. We are adjusting the P ratio because of the risk level of being unlisted and because of the marketability of the securities in the listed company. Then the next one is apart from the P ratio, we also need to calculate the dividend yield. The dividend yield from the listed company data, which is dividend per share divided by the dividend yield. Dividend per share divided by the market price per share will give you the dividend yield. How we get it? Okay. So with this, and we don't have the dividend per share, but we're giving the dividend payout. So we just apply the payout on the earnings per share. So what was the earnings per share? 0.2. Therefore, the dividend per share will be equal to 0.16. Therefore, the dy will be equal to 0.16 divided by what's the market price per share? 2.5. Normally, we use percentage, so times 100. Dy will be equal to
6.4.
6.4%. Okay. And because we want to encourage the company to pay more dividends, so we can say that we increase the dividend yield by 20%. Yes, the dividend yield that we use in our computation. If it is P ratio reduce, dividend yield increase. They are reducing it because of the marketability of the listed company, the risk level, and the rest. We are increasing it because of the same reasons. So what will be the dividend yield?
7.68.
7.68%. It all depends on you because we are not giving specific rates. So this is the information that we need from the listed company. Okay, now let's move on to the main thing. So with the main thing, we are required to use net assets method. So I is the net assets method. And with it, value per share is equal to fair value of total assets minus fair value of total liability divided by number of ordinary shares. So let's start with the fair value of total assets. So let's list all the assets, their fair value. So we go to where the assets are. The first one is PPE. What's the new PPE figure?
222,000.
I told you to attach the new one, 222,000. Then patents. The new patent figure is 500. Then the new development expenditure. With the development expenditure, they are saying that 60% is worthless. So it means that you need only 40% of it. Or you subtract the worthless from the 26,100.
10,440.
So the remaining will be 10,440. That's the 40%. 10,440. Okay. Inventories. Inventories.
It's 32,400.
The new one is 32,400. Okay. Receivables. New one.
20,000.
And bank and cash. Take that one and see. Okay, total assets to me. Fair value of total liability. So let's check our liabilities. You don't forget that if you have preference share capital, you add it to the liabilities. Payables, I don't think it has changed. What was the payables figure?
30,000.
Then 14% medium. Medium loan. 22% irredeemable. 20,000. So total will be 74. What will be the value per share? Value per share will be 0.89. Recalculate it more. Unfortunately, I don't have the spreadsheet. I think I've solved this question.
0.71.
71 per share. Okay. per share is equal to PE ratio multiplied by the earnings per share. So what we need is the earnings per share. And we don't have historic earnings. I think the earnings given are future earnings. So the earnings per share, what was the profit available to the members? Profit after tax, have you seen it? Please, have you seen the profit after tax? 28,500. Then we will subtract preference dividends, if any. Because we need the profit available to the members of the company. So what was the preference dividend? So that one you have to calculate it. It's 22% irredeemable preference share, and the amount is 20,000. So they are entitled to a fixed rate of dividend. So calculate it. 22% of the 20,000 will be 4,400 will become the preference dividend. Please, are we getting it? So 4,400 minus 4,400 divided by the number of ordinary shares of 100. EPS will be please, we want to determine the profit available to the members. So when you get the profit for the year, then you deduct the preference dividend from the profit for the year. In order to determine the profit that is available to the members of the company or the ordinary shareholders. So 0.06 calculation. The value per share will be equal to the PE ratio, which we borrowed it, that is 10 times 0.06. So the value per share will be
0.6.
60 pesos per share. Dividend yield method. And the value per share is equal to dividend per share divided by the dividend yield. So dividend per share, what was the total ordinary dividend? So if you go to the dividend pay, have you seen the dividend pay? 4,400. But this dividend includes preference dividend. Our interest is supposed to be on ordinary dividends. So we're going to subtract the preference dividend of 4,400, determine the ordinary dividend. Then we'll divide it by the number of shares of 100,000 that you told me. So dividend per share will be equal to 8,000. That is 0.02. Therefore, the value per share will be equal to 0.02 divided by 0.0768. So the value per share will be equal to that share. 0.26. You don't have 0.36 per share. This is very good. Okay. Then the last one is discounted cash flow method. Discounted cash flow method. So the discounted cash flow method discounted cash flow method, we're going to discount the future cash flows into present tense because we are in 2016. digital cash flow start from 2017 as given. So we have our table, which is our year, first year for 2017, 2018, 19, 20, 21, 5 years. Then the cash flow. Please, we were told that they have deducted the dividend. They have deducted the depreciation. So what are you supposed to do? You will add that. But if the examiner is silent on whether depreciation has been deducted or not, you assume that it has been deducted. Because you have to deduct depreciation before you get a profit for the year. But if you are told that depreciation is yet to be deducted, then you don't do any adjustment. You use the same figures as the cash flows. Are we getting it? Sometimes the examiner will intentionally tell you that depreciation figure is yet to be deducted. So if it's yet to be deducted, you don't do any adjustment. Okay, so cash flows, let's add them back. 32,000, yeah. 34, 450. Yeah, 3 will be
41,600.
Yeah, 4.
43,650.
40.
36,50.
Yeah, 5 will be
47,360.
okay, then the discount factor, I think is 18%. So 18% year 1. If it is not given, just take your calculator 1 equal to divided by 1.18. You press equal to year 1 will come, you press equal to year 2 will come. But in this particular question is given to you, so you just copy it. So year 1 is 0.847. 0.609.
516.
516.
437.
Okay. Then we have the percent value, which we divide by the number of shares. So please let's multiply. The value per share with future cash flow.
Yeah, fine. First one is 27104. 27104.
Second one.
I have 5. Yeah, 5.
Yeah, 5.
20696.
696. Okay. Okay, so total will be divided by 100,000.
0.30.
Sir, we're going to give the discount factor in there.
So if it is not given,
But we chose to use only the discount factor.
okay, because we use annuity when we have a constant cash flow. let's say 20,000 every year for 5 years, then you use annuity 5 years. 3,000 for the next 3 years, or every year for the next 3 years. That is annuity. Yes, but if the cash flows are not constant, if they are not the same, then we don't use the annuity, we use the discount value.
So if there is constant, we still go through the same thing.
If it is 20,000 throughout. Oh, that one is simple. Yes, right? Yeah, 1 to 5, 20,000. Then you buy the annuity factor.
So you do that
Yes,
formula.
yeah, one.
But they give us different figures.
For annuity. So if it is for 2 years, let's say 20,000 for the next 2 years, it means you use annuity 2 years.
Yeah.
Yeah.
So that is why I'm saying
For the
that.
next 5
But
years,
for
you
this
use,
one-
yeah, 5.
Yeah. But for the purpose of this one, forget about annuity.
You'll never do it.
Okay. If you don't even do annuity and it's 20,000 every year, just use the discount factor and write 20,000, 20,000. You get the same thing. Because when you add this and that is annuity 2 years. When you add this, you get annuity 3 years. When you add this, you get annuity 4 years. When you add this, you get annuity 5 years. That's the meaning of the annuity. You realize that when you add the discount factors together, you are getting an annuity. And you increase the annuity more in finance. And they indicated the annuity because of the patent figure. We were told that it's 20,000 every year for the next 5 years.
So we use the
Annuity 5 years. So for example, if you don't want to use that one, you can just get this and add 1, 2, 3, 4, 5 together. You get the same 3.127. You get the same thing. Because that's annuity. Question number 4. Requirement is in page 19. Question number 4. Let me give you 3 minutes to copy. The number 4, we just discuss it. We will not solve it. And we also discuss another question number 5. When this one, we break for about 45 minutes and come back and do like 2-3 hours. Yeah. Question number 4. Okay, so please, you read the question for us to discuss. Question number 4.
So, requirement first.
Requirements, yes.
Prepare a report for the managing director of Kamasi Limited, commenting on the financial performance and position of Bossman Limited, while renewing the change of name, and highlighting any areas that require further investigation. 2. State the benefits and limitations of the use of accounting ratios in appraising financial performance.
Okay, so that is on the advantages and disadvantages of ratio. So the advantages, we can use the categories, stability, liquidity, and those things. And with the disadvantages, we all know that if the financial statement is created, the ratio analysis will be wrong. Are we getting it? Ratio in itself does not make any sense unless we do proper interpretation. It's a disadvantage. Another disadvantage is that the ratio is prepared from a financial statement which has been prepared from a historic data, and it cannot always predict what will happen in the future. Are we getting it? Issues of inflation can affect the analysis. Unexpected circumstances can also affect the analysis. You need expect COVID data. So the fact that you are predicting profitability doesn't mean that you always get profits. And management judgment in the financial statement can also affect your ratio analysis. There are a lot of management biases which can also affect your ratio analysis. And it's also part of the limitations. Now, with the writing of the report, please, when the question is given to you, just read the first 2 pages or maximum first 3 pages in the exam room, depending on your handwriting. If your handwriting is so big, then the first 3 pages, don't go to the first 4 pages because you waste time. So page 1, page 2, page 3, then you move to page 4 and write a heading appendix. That is, you start from the appendix. So you leave page 1, you leave page 2, you leave page 3, and go to page 4 and write appendix on top. That is where you calculate all the ratios. This question is talking about financial performance and financial position. Financial performance has to do with the income statement ratios, and financial position has to do with the statement of financial position ratios. Are you getting it? But for the purpose of the exam, if you group it according to profitability, liquidity, activity, GRE, the examiner will not punish you. You still qualify for all the mass. Are we getting it? Even though the examiner is looking for financial performance and financial position categories. But if you want to group yours according to profitability, liquidity, activity, GRE, nobody will punish you. It all depends on you. You can also group it according to 2 headings: financial performance, financial position, then you comment on it. Now, with the ratio analysis, the key thing is the formatting of your reports. So you need to start from 2. So it's a report or memo, it follows the same format. Start with 2.
Start out with the categorization. If you divide it into 2, performance and position, what are the ratios that goes on?
Yeah, I said all the ratios that relate to the income statements goes to financial performance. All the ratios that relate to the financial position goes to the financial position. That is if you want to do that categorization. Okay, ratio that we select the figures from the income statement goes to financial performance. Okay. Now, with the formatting, we start with 2, then column will follow. So, the first one, we're writing a report to you. So, prepare a report for the managing director. So two, they are managing directors. So if you go and write to shareholders, you see, somebody will think that they are writing formats. So two, the managing director. From sometimes the examiner will tell you that you are the finance officer. So find out your position before you do the analysis. If the examiner is silent on it, then you just write from accountant or from finance director or from the financial analyst. So from date, then the date becomes the date that you are writing the exam. Then subject will be taken from the requirement. Right? Okay, so the subject can be analysis of gammas, financial performance and financial position. That is going to be the subject. Then introduction. That is where you introduce the report. So you can start by saying that I present to you the financial statement analysis for gammas for 2016, 2017 and 2018 financial years. That is the first line. Then the second line, you state that the analysis will be grouped under the following heads: financial performance and financial position. Or you state that the analysis will be grouped under profitability, liquidity, activity, gearing, and shareholders' investments. Then the last thing under the introduction will be the detailed computation of the ratios have been attached in the form of appendix. So that is going to be the introduction. When you finish with the introduction, you write profitability here. Then all the ratios that you have calculated under profitability, you analyze them together. So you take, let's say, gross profit margin, net profit margin. The gross profit margin shows a positive trend. That is 2015 to bracket 2015 was 20%, 30% this rate. This shows that the company is managing the cost to sell in the current year. For gross profit, comments on the cost of sales. If you're able to reduce the cost of sales, the gross profit margin will increase. For net profit, return on capital, comment on the general expenses. Management ability to reduce the general expenses. Are you getting it? And when it comes to the return on capital employed, strategies to increase revenue and also improve the return on capital employed. Making good use of the available assets can also improve the return on capital employed. Comment on it. But don't write too much. You waste time. Are you getting it? You waste time. The most important thing is comment on the why. After the trend, the figures, comment on the why. Maybe one or two whys will help you to get all the mass. Don't waste a lot of time here. You move on to the liquidity. And under liquidity, current ratio, just comment on the current liabilities. Okay, asset test ratio, comment on the inventory figure. So if the current ratio is better than the asset test, it means that management are holding excessive inventory. Are you getting it? And there are a lot of costs associated with the holding of inventory. You comment on it. When we move to activity ratio, receivables period, you comment on the fact that management are supposed to collect debt from customers on time to avoid capital locking up with their clients. Management are supposed to develop a debt collection strategy to improve on the receivables period, like calling customers on phone. You can suggest all that in the example, giving them emails, sending them text messages. At a point, they can also employ the services of a factoring company to chase their customers for the money. Payables period. Management should have the ability to negotiate with their suppliers on a favorable payment period. Are you getting it? So just comment on that.
On longer terms.
Yeah, the longer the better. So you should be able to negotiate with their suppliers so that you give them extended period when it comes to a favorable payment period. Inventory days to comment on the holding of excessive inventory. Management should try as much as possible and operate within the economic order quantity. That is the quantity they keep inventory to reduce the inventory ordering cost and the inventory holding cost. Because these are the two main costs associated with keeping inventory. The cost to order and the cost to hold. But people are keeping more because they think that the cost of ordering is half. That's another reason why they are keeping more inventory. So the balance of the two is the economic order quantity level. But the economic order quantity level is the quantity you keep your inventory to reduce the ordering cost and the holding cost. So just comment on that. Then when it comes to the gearing ratio, with the gearing ratio, if you calculate the capital gearing and you realize that it's high, you indicate that because the gearing ratio is very high, it will affect the company's ability to borrow more to expand in the future. And if it is favorable, you indicate that because it's favorable, the company can borrow more in the future to be able to expand. Is that you getting it? And if it is high, management should try as much as possible to manage the debt level so that they will avoid payment of higher interest rates. Because if you are highly geared, what it means is that nobody will be ready to give you money. And if the money will be given to you, it will be given to you at a higher cost of capital. Are you getting it? So that's the major reason why we need to manage our gearing level, even though other writers in finance believe that it's good to borrow. And Montigani and Co will tell you that the optimum capital structure is supposed to be 99.9% debt. That means that firms are supposed to borrow. But in accounting, we feel that if you borrow too much, your shareholders will not be happy with you. If you borrow too much, you enter into financial distress. Because if you borrow too much, it means that you have to even go and borrow before you can pay the debt interest, not even the principal. It's not right. So we need to manage the debt level in the company. So after everything, your heading conclusion should be in the report. Okay. So you need to have a heading for conclusion. That is where you conclude the report. If you don't even have anything to say, that heading should be there. Then you add it in conclusion. Management should try as much as possible to strategize to improve on their profitability, improve on their liquidity position, try as much as possible to be more efficient, and also improve on the gearing position of the company. You qualify for all the marks under conclusion. Then when you finish, you sign your report and you write your name, you bracket your position. The formatting of the report is key. The way you format your report is very, very important. And know the formulas. The formulas are not difficult to learn. So that is for accounting ratios.
So to assign the gearing and the if you are asked to comment on repurchase plan, loan covenant, what are some of the things?
So please, with the loan covenant, it all depends on the kind of person that I've been giving to you. Maybe they are borrowing, they have a lot of loan covenants, just like going for a convertible debt.
So you have to do calculation before.
No, you're not supposed to do any calculation. And the fact is that corporate reporting ratios or interpretation should be a bit different from financial reporting. So sometimes the examiner will be adding certain technologies to make it more complicated. But please, don't be moved by these things. Just apply your knowledge, what you know, you get all the marks. Let's look at this question. Page 20, question number 5. The ethics. The ethics question, I've been saying that it's basically the same thing. Okay. And when the question is given to you, integrity will be there, objectivity will be there, in most cases, professional behavior will be there, professional competence, depending on the question, you should be able to raise it. And for confidentiality, it depends on the question, then you also raise issues of confidentiality. Then when it comes to the strategies to reduce the risk to acceptable low level, if you are a finance director and you realize that your CEO is worrying you, what are you supposed to do? Try and get to the board chair and let the board chair be aware of what is happening in the company. So informing the board chair is a safeguard. Please, documentation. Documentation too is a general safeguard. And I've been saying that most of the questions, sometimes you don't even need to read the case study to get the safeguards, because it comes with the same safeguards. Strategies used to resolve the ethical issue must be documented. It's applicable in any ethics question in corporate report, and it's part of the safeguards. The steps taken to resolve the matter are supposed to be documented. The finance director should try as much as possible, depending on the issue, to notify the ICAG about it. Are you getting it? Then they have to try and get to the board chair, let the board chair be aware of what is happening. And you add one or two issues in the case study to qualify for all the mass. Okay, so read question number 5, we discuss it together. We move on.
You are discussing the ethical issues arising from the information.
A. Explain how the finance director potentially acts in order not to take fundamental principles of.
Okay. So should I read again?
Yes.
Explain how the finance director could potentially act in order not to breach the fundamental principles of the IFAC Code of Ethics.
Okay, so it means just identify the fundamental ethical principle given by the International Federation of Accounting, the IFAC. It's the same 5. Integrity, objectivity, professional competence, and legal confidentiality and professional behavior. It's the same 5. Anytime you spot issue of non-compliance of laws and regulations, you add it to professional behavior. If you spot issues relating to threats to accountants' independence, you add it to objectivity. And for integrity, which has to do with being honest and straightforward, it's everywhere in a case study. Are you getting it? And if you are given a question relating to where the accountant has interest in informing friends or family members, you raise the issue of confidentiality. Are you getting it? Okay. Main question. Then B.
Recommend the possible actions that the finance director.
The ethics is an area to pass. It's an area to pass. Get all the 10 marks there. Add your interpretation. And face the capital reduction and business valuation. You are close to passing. Face the consolidation. Because consolidation, apart from the cash flow, what we have solved, it's a matter of adding figures together. Okay. Then you face the standards as well.
To recommend the possible actions that the finance director should take as a member of the Institute of Chartered Accountants in dealing with this ethical dilemma. Fiaja Limited is a retail trading company in Ghana. Nanaya Otabula, member of ICG, is the finance director and has been in this role for many years. Fiaja Limited has a year-end of 30th June each year. Nanaya Otabula is finalizing the financial statement for the year ended 30th June 2019. On one hand, the warehouse manager of Fiaja Limited has recently advised Nanaya Otabula of a significant level of slow-moving inventory, and that the inventory in question is now more than 7 months old, and per the company policy would usually have been written down for months previously. On the other hand, the shareholders of Fiaja Limited are trying to sell the company. The chief executive officer, who happens to be the majority shareholder of Fiaja Limited, has told Nanaya Otabula that it is not necessary to write down the inventory values in the year-end financial statement. Nanaya Otabula is sure that the CEO wants the financial statement to carry an inflated inventory valuation because he has found a prospective buyer of the company. The CEO has indicated to Nanaya Otabula that if the proposed deal is indeed successful, all employees will keep their jobs, including Nanaya Otabula. And the finance director, Nanaya Otabula, will receive the pay rise.
Now, so questions like this: which of the ethical issues are being raised? So integrity is generic. Okay, so integrity, how are you going to answer it? So please, answering the question in line with the case study means be using the names. That is the meaning. Just be using the names and the technologies in the case study and you apply the knowledge. You know, we all know that integrity means being honest and straightforward in all your dealings with your clients. Okay, so it means you have to use the name of the finance director and tell him that he has to be honest and straightforward when it comes to the measurement of the company's inventory. And it's not supposed to listen to whatever you see. Okay, so integrity is obvious. Any other extra issue? Objectivity. So objectivity means that he's not supposed to allow his interest. You know, they have promised him that he's going to get a pay rise. If he go and make changes, he get a pay rise. So it means that he's not supposed to allow his interest of getting a pay rise to affect. Yeah, because objectivity means that you're supposed to be objective. You are not supposed to allow bias or new influence or conflict of interests. Influence our work as an accountant. Professional behavior to the measurement of events is supposed to be in line with the standard. Okay, not in line with whatever the CEO is also saying. So you can just talk about this and all the mass beginnings. You can also add professional competence when it comes to the understanding the standard on the evaluation of the company's events. Okay. For confidentiality, you may decide not to talk about it because this one may not really require any confidentiality related issue. Then the safeguards. Apart from with the safeguards, just go and reverse whatever you say under raising the issues. Then you add a free 3 points. The free 3 points will be you should take steps to inform the board of directors about the issue if the CEO is pushing it. Okay, it's a safeguard. Another safeguard is that you should try and inform the Ministry of Tax Accountants Ghana if the CEO wants to force you to do things which is unprofessional. Okay, maybe the audit, you know, the finance director does not really have a direct, if it is an internal auditor, that is where, or auditors, that is where you raise issues about informing the audit committee. So that's the difference between the auditing bit and the corporate reporting bit. So the corporate reporting concentrates much on the board rather than the audit committee. I get it. Even though the audit committee is there to ensure the integrity of the financial statement, but they work more with auditors than the finance directors. Okay. You can also add that the processes in resolving the issue are supposed to be documented. This is a generic point and it's applicable in almost all the questions. So please, when it's given to you, you need to also apply that point so that you need to do it. Okay, any other? You can even suggest that, which is always the last point, if the CEO is threatening him and forcing him, he can resign. Okay, so please, I don't know whether we should solve one other question before we go, or when we come back and solve. What's the time? Perfect, right. Oh, okay. So we are coming back at 1:30. So 1:30 we'll come back and discuss other questions. We'll come back and solve standard questions and also solve one question on foreign subsidiary before we go. The question number 1, we need to solve that question. We are coming back by 1:30 so that we will do 3 hours by 4:30.